This year's election could have some massive implications for your Roth conversion and tax strategy in retirement. And we're going to discuss why in today's video. Let's get into it. Before getting into the content of today's video, I want to provide a few disclaimers here off the front end. First, this is not meant to be a political video that has some implicit message about who you should vote for. This channel takes a very neutral, agnostic stance on politics. At some point, I plan to do a breakdown of both presidential candidates' tax plans and what they mean for retirement. But at this point, presidential candidate Harris has not yet released a tax plan. We also generally believe that you should plan based on the rules as we know them today, rather than making some prediction about where taxes are going to go in the future. However, this video will slightly break that mold, but I think in a very cautious manner. Let me explain. If you've been watching our YouTube channel for some time, you should be acutely aware of this tax window of opportunity that we currently find ourselves in. Starting in 2018, the Tax Cuts and Jobs Act was installed and led to some massive opportunities in retirement tax planning. However, this tax law has an expiration date. Come 2026, this tax law will expire and we will revert back to the old 2017 tax brackets, inflation adjusted to today's dollars. Now, there are a few reasons the Tax Cuts and Jobs Act has been such an opportunity for retirees and other taxpayers. The most obvious opportunity comes in comparing tax brackets. Outside of the 10% and 35% brackets, all tax brackets are set to rise by 1 to 4%. And these increases aren't just for the wealthiest of Americans, but rather some of the biggest adjustments take place in the middle and upper middle class parts of America. But tax rates aren't the only adjustment. In both the single filer and married filer situations, where the tax brackets are located will also have some major shifting. Married filers will see certain brackets condensed down. For instance, the current 32% bracket will not only see a 1% increase up to 33%, but we will also see the start of this bracket fall by nearly $100,000, meaning you are going to have less room, which will lead to smaller Roth conversions if you try to max out the 24% bracket, what will be the 28% bracket. For single filers, a somewhat opposite shift will occur where a single filer will actually have more room in both the 24 and 32% brackets. In some respects, this is a good thing. But remember, the tax rate is still going up in these brackets, which doesn't make this a clear winner for this expiration of this Tax Cuts and Jobs Act. Then finally, another important adjustment will be a smaller standard deduction. For a single filer, the standard deduction will drop by about $6,500, and for a married filer, the standard deduction will drop by over $10,000. Now, some of this will be minimized by the allowance of a personal exemption. This effectively gets added on to a standard deduction. The problem here is that this personal exemption will phase out for both single and married filers at certain levels of income. So it's not truly a standard deduction. If you're doing big Roth conversions, you will phase out that extra personal exemption. But either way that you look at it, the deduction allowed will still drop. Effectively, what is happening with all of these changes is that more of your money will be taxed than is currently taxed, and unfortunately, it will be taxed at higher rates. But here's the thing. The Tax Cuts and Jobs Act were originally installed as part of the previous Trump administration. Now, if we look at Donald Trump's current proposed tax plans, we see that he has targeted to make these tax cuts permanent. Now, obviously, he will need Congress to cooperate to some degree. But given that we will know the election results by end of year, we are keeping this top of mind with our clients and their Roth conversion strategies here at Safeguard. Now, let's take a step back for a second and talk about why. First off, when we are doing something like a Roth conversion involves taking money from your tax-deferred accounts, paying taxes on those amounts, then this allows you to convert those deferred dollars to Roth dollars. A Roth conversion isn't inherently better just because a Roth account grows tax-free. In fact, to know whether a Roth conversion makes sense or not, you really need to know what rate you would otherwise plan to withdraw from your tax-deferred accounts in the future. We can't perfectly predict every variable to find this rate, but we can get quite close with a solid forward-looking tax plan that estimates out RMDs and other retirement tax hurdles in the future. From there, we have to compare the rate we could convert at today versus the rate we would otherwise pay on withdrawals in the future. If the rate today is lower than we would see in the future, we know a Roth conversion will make sense. If the rate you pay today is higher, then a Roth conversion should not be recommended. A simplified proof of this is shown on the screen. If we equalize out the tax rate that we would pay in both scenarios, both on a Roth conversion as well as withdrawals, we end up having the same amount of money in both a conversion and non-conversion scenario. But if we are comparing rates versus rates in making Roth conversion decisions, many retirees are finding it beneficial to Roth convert more aggressively today. For instance, let's say we expect you to see the 22% bracket in the future in retirement. As the rules sit today, the 22% bracket is set to increase to 25%, meaning future tax-deferred withdrawals will be taxed at 25%. Because of this, a very common strategy is to optimize around the Tax Cuts and Jobs Act, which typically leads to retirees maxing out the 24% bracket now, then maxing out the 25% bracket after 2025. Because 24% is less than 25%, we know there are going to be some benefits in going more aggressive. I also find other retirees are going more aggressive in other ways, like maxing out the 32% bracket to avoid seeing the 33 and 35% brackets later on. Again, this is all great. More aggressive conversions make sense for a lot of families. But this year is a little bit unique in the fact that we're going to have a lot more information by the end of the year. What is likely going to be the future of our tax code here in America? If presidential candidate Harris is elected, I think one can be comfortable in assuming the Tax Cuts and Jobs Act will expire and potentially a whole new tax regime will take its place. However, if candidate Trump is elected, the probabilities that the Tax Cuts and Jobs Act are extended increases substantially. In fact, it may lead some retirees to back off the aggressive Roth conversions altogether. Converting up to the 24% bracket will make a lot less sense if you can solve your tax problem by staying in the 22% bracket indefinitely. Here at Safeguard, this is leading our team to wait on finalizing more aggressive conversions until after the elections in November. Yes, we have been converting earlier in the year up to this point, but we are pausing on a portion of the conversions, the more aggressive portion, until year end as we will have more data. To show the data and impact we've been discussing in a different way, I've laid out 4 common max the bracket conversion strategies and compared the amounts and effective tax rates you would be paying now versus 2026 if the Tax Cuts and Jobs Act expires. We'll first look at married filers. Now these amounts are assuming a couple would have no other income and just looks at the maximum conversion room you would have. Across the board, we see the effective tax rate on conversions will rise significantly, and in most cases there will be less room to convert. For instance, let's take a look at the 12% maxing the bracket strategy. Come 2026, you will have approximately $4,000 less of conversion room, but your tax bill for this conversion will also rise by more than $4,000. That is a substantial increase when we're talking about converting just a bit more than $100,000. And we continue to see a similar trend all the way down. For single filers, things change in a bit different way. The one thing that will remain consistent when comparing to married filers is that the effective tax rates on maxing brackets will rise come 2026. And again, this is consistent across the board. However, when we look at the 24 and 32% brackets, what will eventually become the 28 and 33% brackets is that we see a bit more conversion room after the Tax Cuts and Jobs Act expires. Right now, if you were a single filer maxing out the 32% bracket, you would have just about $258,000 worth of room to do so at most. Come 2026, you will be able to show more than double that in terms of maxing out the 33% bracket. Now, more conversion room is a positive, but it would be a big stretch to say the Tax Cuts and Jobs Act expiring is a positive for single filers. We still see that the rates rise, which is key in the discussion here. And so again, to wrap this all up, this election in the fall could have significant implications for your retirement tax strategy. This might mean some decisions are best delayed until the end of the year when we'll have more information about the future and we'll be able to adjust our probabilistic frame of mind, if you will. But this is only the case if you are going with more aggressive Roth conversions right now. If you find that you're going to stay in the same bracket on a consistent basis now and after the Tax Cuts and Jobs Act expires, then this is less key in your Roth conversion strategy. Now, if you found this video helpful and are looking for additional ways to lower your taxes in retirement, click on this video right here where I discuss 10 all too common Roth conversion misconceptions. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.